You were sounding very cautious on stocks last time I talked to you, maybe a few weeks ago. Are you feeling a little better given the recent action?
Well, it's not just the action in and of itself. Momentum is always a good thing. But what was most intriguing to me over the past couple of weeks, and I'm a bit biased with this indicator, but we got what's now known as a Zweig breadth thrust, named after my first boss in this business, for whom I worked from 1986 to 1999, Marty Zweig. So that is when you have at least 90% of volume going into advancing stocks. And we got kind of a double breadth thrust in the last couple of weeks. So technically, from a breadth perspective, that's a very strong sign. We also saw really washed out sentiment, near record put call ratio. So those tell me that maybe this rally, at least in the short term, has legs. I think we've eased some of the Fed uncertainty, although not all of it, with regard to, if we get two more really strong jobs reports. I do think March is on the table. We haven't really resolved the trade issue yet. So I think there still are some uncertainties, but at least from a technical and a sentiment perspective, this rally looks pretty decent.
Liz Ann, I read all the notes you sent us earlier about this breadth thrust, which I enjoyed a lot.
Why breadth thrust?
I know, I wasn't sure how to pronounce the first word, so I dropped it. Anyway, very interesting, but I want to focus on one part of it, and you mentioned the word there, that it only leads to a short-term rally. This isn't the start of a big new bull cycle, right?
Well, we don't know. We've had breadth thrusts that have led to strong, even if they're just interim, strong cycles. We've had exceptions, though, notably a few of them in the mid-1970s and then again in the 2007, 2008 period. So clearly those exceptions are notable exceptions. So it is not an all clear sign. And that's why I pointed out that some of these more macro uncertainties that have been plaguing the market for some time now, they're not new, haven't really dissipated to a significant degree. So I think we still need answers to some of those questions. We are late in the cycle as well. So I think the chances that this is some sort of off to the races new leg of an ongoing bull market, I think that the chances of that are relatively slim.
Yeah, Liz Ann, I was actually going to kind of bring that idea up of where we are in the cycle and how it relates to where the market might go, because it seems that we did get a bit of, kind of welcome clarification on the Fed, as you say. We kind of are on board with the idea that maybe earnings estimates have to come down, but it doesn't seem to liberate us from this idea that, good news leads relatively quickly to the possibility of a tighter Fed or something else. So how do you think the market's going to digest all this as we go along for the rest of this year?
I think we're in a bit of a sort of a narrower point in time here. There have been times in the past, not that we want to cheer for negative economic news, but times where weaker news tends to be cheered by the market because of what it means for monetary policy. Times earlier in the cycle where you unquestionably want to cheer for better economic news because you're not at the point of having to worry about the Fed. I'm not so sure we're in this binary situation anymore. I think we've got a narrower opportunity for the market. I don't think the market would necessarily cheer much stronger economic news because of what it means for the Fed later in the cycle, what it probably means for the yield curve. Nor do I think the market in this stage would cheer very weak economic news because we're late in the cycle. It would likely mean a shorter runway between now and the next recession. So it is a different environment than what you tend to be in earlier in the cycle.
So give us a sector, Liz Ann, of where you want to be right now, given you're encouraged, at least in the short term, by this rally, but not so sure whether it's going to last. Still have some big question marks on the macro factors. Where do you want to be?
So in August last year, we made some changes to our sector recommendations. We downgraded both technology and financials from outperform to neutral, and we upgraded from underperform to neutral both utilities and REITs. That left just healthcare as an outperform and just communication services, which was a brand new sector at the time, as underperform. We have not made changes to those. So that's clearly a bit of a defensive tilt. Now, healthcare, I would say, is kind of a hybrid sector because it's got those defensive characteristics, high dividend yield, strong balance sheets, but it's still got that potential growth component. And we think that's the kind of area you want to be focused on right now, not purely hunkered down in nothing but defense, but that opportunity to get some upside because of decent growth characteristics.